Think of the internet infrastructure like the railroads 150 years ago, and think of the tech stocks as a company selling railroad ties, building the guts of the internet. So once the railroad is built, while you're building the railroad, your sales are going up 50, 60, 70% a year. But once the railroad is built, your growth not only doesn't go up 70%, it goes down, because on a rate of change basis, you don't need any more railroad ties. So what none of us saw, me included, in early 2000, were a lot of these companies with estimates of 50, 60, 70% for the next 2 or 3 years, their business was literally about to collapse. So the NASDAQ went down 95%, not 30, 95, because you had this combination of inflated values, way overestimated earnings out there, and then earnings collapsed. So today, you have something similar and something different. So monetary policy is absolutely insane. We had no QE back then. Our rates weren't 0. They were 4 or 5 when they probably should have been 6 or 7. No comparison. So we have an asset bubble now that's not just in tech stocks, it's in everything. SPACs, Dogecoin, although maybe some of the young viewers disagree. You name it, if you're an asset, you've been moving. But what we also have, back then, you had this incredible wave from 95 to 2000 while the internet was being built. What you have now is this incredible wave of digital transformation, particularly moving on to the cloud. And I used to say 2 or 3 years ago in some interviews, well, we're in like the bottom of the first or the second inning, and this is a 10-year runway. Well, COVID sort of jumped you from the bottom half of the first to the 6th inning.
Wow.
Not the 9th, but to the 6th.
Right.
I think the guy from Shopify said we went from 2019 to 2030 in 1 year because of COVID. I think it was him. I think the difference now is if you're a customer and you haven't moved to the cloud, you're dead, because who you're competing against, they can just beat you because the technology is so important. So now, full disclosure, I didn't see what was coming in 2000 coming, but I am really hard up to come up with a scenario while this digital transformation thing is going to collapse and these SaaS companies are going to go away. And the biggest problem you have now is the overall bubble in asset prices and where price got to these names in particular. The good news is, if we had this conversation 2 months ago, the good ones were like 45 or 50 times sales, not earnings, sales. They're down to, there's a range, I'd say now 10 to 25 times sales for the good ones. So if the problem is price, and in my opinion, that is the problem, a lot of that has been wrung out. And I think if you hold these names for 3 or 4 years, they can easily grow into their valuations, where if you held the names in 2000, a lot of these companies, you still had losses of 90, 85, 90% of your value. The other similarity is back then, I remember a lot of value managers were virtually going out of business.
Right.
At the end of 2000, one of the greatest investors of all time, Julian Robertson, who was long value and short these crazy tech names, he basically threw in the towel and said he couldn't take it anymore and stopped managing money in early 2000. But what happened in the next 3 to 5 years was incredible. Companies like Phelps Dodge, copper companies, went up 6 to 8 fold, 6 to 8 times for the old industrial stuff. So everything Julian was long went up many fold, and the tech stocks went down a lot. We do have some similarities there today because these COVID companies, beneficiaries, so much demand was pulled forward that they got too high and too much ownership. And as we're reopening, there's also an ownership problem where there's probably more money that needs to rotate out of the secular growers into these, I'll call them reflation names. But I do want to say very differently, I think these things are secular growers and they'll probably be fine long term. Amazon at 3,200 is not a bubble stock, not whatsoever. It's basically decent value. And you can even go beyond that and look at industries that lead the economy and industries that lag the economy. The obvious one that everyone knows about is housing, has traditionally been looked at as a leading industry. Retail has a slight lead, capital goods lag. And what we've done historically is actually, even though you referred to me as a macro investor and many people have, is we do the macro by a compilation of listening to companies and doing a bottoms-up analysis of companies that lead the economy industries that lead the economy and industries that lag the economy. And if the leading industries are turning up or turning down, that's a signal. And that's worked beautifully historically. The other signal, which I have found quite prescient from markets, is the bond market. Unfortunately, the last 10 or 11 years, the bond market has not signaled anything because the central banks took it upon themselves to manipulate bond prices, which to me is the 10-year treasury has sort of been the most important price in the world. And they took that price out of the equation as a signaler. I remember last summer when certain forecasters had a different forecast than my own, kept talking about, well, the bond market is saying this, the bond market is saying that, when the 10-year dropped all the way from 170 to 115, which, by the way, I did not anticipate. But the bond market wasn't saying anything. What was going on is central banks were buying trillions of dollars and manipulating the price of bonds, so there was no signal. I don't think you get that tainting if you look inside the stock market. You could get it in the stock market as a whole, but if you do this approach where you look at industries and which lead, which lag, and you put the puzzle together, it's been prescient over time, and it's certainly allowed us to consistently the last 20 or 30 years outperform the Fed in terms of economic forecasts.
I find that really interesting, equities acting as kind of this synthesized predictors for certain industries. And so say, if you think about understanding what's going on in housing, again, the economy now, what kind of concretely, what will you be looking at? Is it publicly traded REITs? Is it, the stocks of construction companies? What does that process look like for you?
Well, you don't need to get real fancy here. You can just do the home builders themselves. And with supposed good fundamentals, they've all declined 50% from the high. Another industry that's been incredibly prescient has been trucking. And they're down 40% from the high, despite the fact that they're all reporting record earnings. An industry that is not that much of a leader, but it's more of a leader than a laggard, is the retail industry. And there's been a lot in the news lately, whether it's Walmart or other companies, retail. That one's a little tainted. You just can't take these things blindly, John. That one's a little tainted now because in COVID, retail went to 100% of the wallet from about 85% because we weren't going outside and traveling and going to football games. But even taking that into account, retail appears to be much weaker than it should be given what the so-called GDP numbers are printing. So right now there's a signal, albeit early, that there may be trouble ahead.
Yeah, so you look at trucking stocks being down 50%, and you say, okay, this probably does not bode well for trucking volumes. It kind of has to be the case.
Yeah, and if it was just trucks, fine, but it's not just trucks. It's housing, it's retail, it's all over the place. And by the way, you can't get too carried away and say that means we're going to have a recession tomorrow morning. A lot of these things have longer lead times, like 6 months to a year.
Yes. One thing you're also getting at here, kind of when you reference that you used to be able to look at the bond market and kind of now you can't, is it seems very true that the investors who perform really well over multiple decades have to shift stylistically over time and become new kinds of investors. I kind of love the stories of the value investors back in the day, where if you look at what Ben Graham was actually doing, you're hunting for companies where the book value is greater than the market cap of the company. There's a famous case of Northern Pipeline where they were trading at $65 a share, and they just had $95 a share of stuff and railroad bonds or whatever on their balance sheet, and he bought a bunch of their stock and then just yelled at them and complained until they finally dividended out $95 a share of their assets. But that doesn't work anymore, obviously. Markets have gotten a lot more efficient, and you can't just buy companies that own more assets than their market cap. So value investing has to change. And similarly, you're describing here, especially, the relationships with bonds, relationships with currencies have to change. And so I'm curious, can you talk a bit more about how you stylistically have had to change the tools in your toolkit?
That's really an excellent question, and it's right on point, because when I got in the business, you could almost guarantee if a company reported lousy earnings, opened down that day and closed up big, that stock market was going to be higher 6 months from then, and vice versa. You could almost always guarantee if the economy looked great and bonds were rallying, that meant the economy was not going to look so great. We used to call it price action versus news. And it used to be an incredible indicator of security prices, partly because of the efficiency, partly because I think the growth of hedge funds, we all learned these rules, and partly because of central bank manipulation. Price versus news is a very weakened tool versus 20 years ago, much to my chagrin, because I always found it a great warning signal, and now a lot of times it may be warning of nothing or warning of something that doesn't exist. So that's been one thing I've had to adopt to. I mean, frankly, when I started in the business, I'm showing my age here, which was the mid 70s, I started in equities. And I also learned, particularly in bear markets, that I had to morph into bonds, into commodities, into foreign currencies, things like that. I mean, one of the most challenging things for me right now is, maybe it says something about my dysfunctional personality, but I've always made even higher returns in bear markets than bull markets. But the way I did it was just pretty much ignore equities, take them off the table, buy bonds, buy treasuries, and go home. Well, I've never been presented a cocktail where you have 8% inflation, you think the economy might weaken, and bond yields 3%. It's an analog with no precedent in history. So for the golfers out there, going into the situation we're describing, I feel like I'm about to play a round of golf without a driver and without a 60-degree wedge, because bonds, which have been my go-to asset in terms of a recessionary bear market atmosphere, they may work, but there's good reason to believe things may be different this time, because we've never had central banks with situation in Europe, for example. We have negative rates with 8% inflation, or even here, we've never had anything like this. So you can't get into black and white. That it's an art form, investing in. From cycle to cycle, you have to constantly innovate and not just be a slave to past models.
So how are you positioning the fund, given that, maybe you don't feel so good about going long equities, but your normal bond toolkit is not working quite well? Is the golf thing top of mind because, it's actually hard to do too much? Or how are you positioning things?
Well, currently I'm very challenged. We were lucky enough to have made some money up until now, the last 6 or 8 months, primarily by having let me call it a matrix of short fixed income, short stocks, and not doing a whole lot in currencies, and owning some of the key commodities, particularly oil and mistakenly gold, but copper. Um, things are a lot harder now because we're now getting definitive signals that the economy may be weakening, particularly at the front end. And while I'm not comfortable owning bonds, I'm much less comfortable being short fixed income to the degree I was 3 to 6 months ago when it looked like a much better risk reward. And even stocks, so many companies have been derated by 60 or 70%. And I've lived through enough bear markets that if you get aggressive in a bear market on the short side, you can get your head ripped off in rallies. So currently I'm coming in every day and I'm looking at my screen, but I'm pretty much taking a break. I'm waiting for a fat pitch. I'm not shooting at any pins, to use a golfing analogy. My anticipation is I will be going back to the short equity position at some point if the market affords me. If not, hopefully I'll just sidestep a decline. That's not the worst thing in the world. But the fixed income market has become much more complicated. And I'm lucky enough, since I play in a lot of asset classes, to have the luxury of not playing in one. And I don't think I'm going to be playing much in that one going forward. The currency market is incredibly interesting to me. I haven't been doing much there, and I'm not currently positioned aggressively there. But I will be surprised if sometime in the next 6 months I'm not short the dollar. $14 trillion has come in here because we were the first to tighten. There's a story about American exceptionalism. I'm not sure we're so exceptional anymore, and if we are, I'm not sure I'm excited about what we're exceptional in. So foreign exchange looks interesting. We still own energy and other commodities. Ukraine sort of gave that trade an extended life, although I must say the energy, because of the transition to ESG, we look to be short energy for 5 or 10 years, so that could last a while.